Hey everyone, welcome back to Corporate Decoder. Today we're diving into a 10Q filing, and let me tell you, this one's a bit like a magic trick. The company tries to make things look impressive, but we're here to see what's really going on behind the scenes. Think shrinking revenue and costs cut to the bone. Ready to decode. Let's jump in, but before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below, so join us. This is Identiv, and we're looking at their quarterly report for March 31, 2025. It's basically a snapshot of how they did in the first 3 months of the year. First off, let's hit the high notes of the balance sheet. This shows what the company owns and owes. Think of it like a personal budget. Assets are what you have, liabilities are what you owe. Cash and cash equivalents are sitting at $132.4 million. That's a pretty big number, right? Well, it's down from $305.6 million at the end of last year. So they're burning through some cash, but it isn't a huge amount. Accounts receivable or money owed to them are down to $3.06 million from $4.2 million. Basically, people are paying their bills a little slower, which can hurt cash flow. Looking at total assets, they've dipped from $163.23 tom and 7 million DNs. It's not a financial catastrophe, but it's a slight shrinking of the business. Total liabilities are at $8.2 million, down from $9.2 million, so they lowered their debt a little, which is a positive. Alright, let's dive into the income statement. This shows how much money they made and how much they spent. It's all about revenue and expenses. Net revenue is $5.3 million, down from $6.7 million last year. That's a 21% drop. Losing 1 in 5 customers, not good. It's like losing a chunk of your customers all at once. Gross profit is even worse. It's down 73% to just $1 million. It means costs were not managed well relative to sales. They cut research and development spending by 12%, which might save money now but could hurt innovation later. Spending 15% of revenue on R&D doesn't sound too bad on its own, but when that spend doesn't bring in revenue, then you get a very bad situation of spending too much on R&D. On the flip side, they increased selling and marketing by 20%. They're trying to sell more to make up for lost revenue, but it doesn't appear to be working. General and administrative costs are down 10%, so they're cutting back office expenses. Ultimately, the loss from continuing operations is $5.5 million. It shows the business is not sustainable at this point if it continues in this direction, because they lost a lot more money. Their income tax provision is very minimal, probably because they don't make that much money overall and can offset some taxes with losses. So here's the bottom line, a net loss of $4.8 million. The core of their business is not profitable. This all translates to a loss of 21 cents per share. That's what shareholders lost and is quite bad. Now, let's look at the cash flow statement. This is crucial for figuring out if the company is actually generating cash or just burning it. First off is the net loss that we already know, $4.8 million. There are also non-cash expenses such as depreciation and amortization of about $0.5 million. Stock-based compensation is $0.8 million, giving company stock to people instead of paying them. The key number is this. Net cash used in operating activities is $3.3 million. That means they're burning through cash just to keep the lights on. This is usually what matters the most and will make or break a company. They spent about $0.3 million on capital expenditures. They spent about $0.2 million related to taxes. Overall, their cash went down $3.3 million. This was offset a little bit by the effects of exchange rates on the Thai baht. Digging deeper, we see that their sales are broken down by region. The Americas account for 42% of sales, Europe and the Middle East for 34%, and Asia Pacific for 24%. They are pretty evenly distributed across the world. Also, this part raises a red flag. One customer accounts for 16% of revenue. You really don't want any single customer to take up this much of your business, as they can leave at any time and ruin revenue. The legal section notes they might be involved in lawsuits, so that's something to keep an eye on, but is fairly normal. Here's a critical risk they mention, changes in US trade policy and the impact of tariffs. This is something that they need to watch closely. The company has significant issues it is trying to overcome. They say in the report that they are dependent on pace and adoption has taken longer than expected. This can cause significant fluctuation in revenue on a quarterly or annual basis. One positive thing about them is that they are using renewable assets that can have a better effect on the world compared to other non-renewable forms of energy. Overall, this report doesn't paint a pretty picture. Revenue is down, costs are high, and they are burning through cash. The company is facing some big challenges and needs to turn things around quickly. So what's my take? They really need to focus on a few things, primarily increasing sales. It just really isn't sustainable, so they have to turn things around quickly. Alright, that's our breakdown of Identiv's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.